Well, hey there, everyone. Happy Wednesday, August 6th, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a kind of beautifully rainy Redmond, Washington. It's back to a kind of normal Seattle, probably late fall, maybe early spring day, right? Highs in the 60s, kind of a nice misty rain. My whole family lights up in a morning like this when it's all rainy outside. So, we're doing fine here. Hope you guys are hanging in there and doing well wherever you're at. We are kicking off about an hour plus later than normal. Apologies for that. I was doing the IBD Live podcast, actually investing with IBD podcast. Apologies, guys. And that was done live, and I couldn't get the timing to work around the show. So having to do this a little bit later. I apologize for that. But those of you that did, if you did tune in, hopefully enjoyed the conversation with Justin Nielsen. A lot of good discussion about breadth indicators, leading versus lagging indicators, a couple different charts to look at. Overall, it was a decent amount of fun. But I hope wherever you're at, you're hanging in there and doing well. We are live streaming on Facebook, LinkedIn, YouTube, and X. And appreciate your questions as we go along. Any of those platforms, if you're watching live, you can drop a question as we go, and we'll grab a question or two at the end of the episode. All right, let's get right to the markets here. After the close, I saw the headlines, President Trump talking about 100% tariff on semiconductors, on chips made outside the U.S. Seems like the futures market are kind of, processing and not really significantly moving up or down after that announcement. But we'll see if that weighs on equities tomorrow. Overall, not a lot of economic data this week. This is more about wrapping up earnings season and this just seeing what we see here. For what it's worth, the S&P having a decent update today, up about 0.75%. S&P closing at 63.45, closed near the highs of the day, which is pretty encouraging. NASDAQ Composite up 1.2%. The Dow slightly above the zero level. Mid caps and small caps both down today. The VIX moving back lower, about a 1 plus VIX points to just below 17. So, VIX in the mid-teens is a low volatility environment. That tells you conditions are good. We had a warning there end of last week with the market selling off to the 21-day exponential moving average. The VIX for 1 day pushing above 20 and rotating back lower here for this week. So we're back to kind of a low volatility, long and strong bullish market environment. Our short-term market trend model did turn bearish on Friday. But so far this week would technically push back into the positive territory. All right, looking at interest rates, you can see the yield curve generally drifting higher here. The 10-year yield finished around 4.22. The long bond yield just above 4.8%. Yields generally drifting higher. The TLT, which is what we use as a proxy for bond prices, down about 0.6% today. And the dollar index down about the same. So weaker dollar, weaker bonds, stronger stocks is the story. Looking at the commodity space, silver flat today after, again, just absolutely crushing most equity indexes in 2025. Sort of flat today. Gold down slightly, less than 0.25%. But the GLD pulling back a bit here. You can see crude oil prices coming down, which means energy stocks didn't have a particularly great day. Looking at cryptocurrencies, mostly in the green here. You can see Bitcoin pushing back above 115,000. Did drift lower here in the last couple hours, but overall in good shape. Ethereum currently around 3670 and change, up about 1.8%. Looking at the 11 S&P sectors, we can see it's consumer at the top of the list, particularly the XLY consumer discretionary up 2.1%, by far the best performing sector and definitely outpacing the S&P 500 today. Consumer staples, though, number 2, up 1.4%. Technology, number 3, up 1.1%. On the downside, healthcare down 1.5%. Materials down over 1%. Energy down right about 0.9%. So not a real clear kind of sector theme here. If you think about, I tend to think of sectors in 3 general buckets. You have, kind of growthy offense. You've got cyclical or value sectors, and then you have defensive sectors. And I'm seeing a little of all 3 at the top, a little of all 3 in the middle, and a little of all 3 in the bottom. So this was not, I would argue, a very clear growth over value or offense over defense. Maybe you could say offense over defense is fair to say because you've got real estate, utilities, materials, healthcare all down today. That's fair. So generally, maybe a more of an offensive day than defensive. Although the breadth was not particularly strong, right? Looking at the breadth conditions, you can see the New York Composite Index almost a coin flip between stocks higher and lower. A little better for the S&P 500, 52%. Sorry, a little worse for the S&P 500, 52% decliners versus 48% advancers. But those aren't horrible numbers. They're really neutral. They're shaded kind of in this neutral amber color. And I think that's pretty fair. This is an equilibrium kind of day more than anything. All right, looking at the where am I going to go next? Down here to the Magnificent Seven and Friends. This is where things really started to happen. Banger of a positive day for some leading growth names, in particular Apple up over 5%. This is on the news about big investment in the U.S. that was announced from the White House today. Amazon up 4%, Tesla up 3.6%. Those two moves are what are causing the XLY to be the top performing sector. Those are the two top weighted names in the consumer discretionary sector ETFs. Broadcom up as well, about 3%. Microsoft down about 0.5%. That's the only of the Mag 7 names that were down. I mean, since Microsoft reported earnings, it might be a little hard to see, but since Microsoft reported earnings here, I mean, 4 of the last 5 days have been big, solid candles. And what that means, if you look at the little candle chart, that means a higher open and a lower close. So we open at the highs of the day, we close more toward the lows of the day. That is intraday kind of negative sentiment, right? That's during the trading day, there's distribution happening. Otherwise, the candles will be closing higher. So that weakness that you're seeing through the course of the day, except for Monday's session, which was actually an up close, but the rest of these post earnings have all been down closing. And what that implies to me is after that gap higher on earnings, there's been a lot more sellers of Microsoft than there have been buyers of Microsoft, as evidenced by the fact that the price is generally trending lower there in the short term. All right, shall we look at the market recap? We did that. Let's look at the heat map analysis, which is called the market carpet on stock charts. I love the visualization like this. Gives you a high level kind of general view, but also lets you to go granular and look at individual names. I think what jumps out at me are a couple things. Number one, look at a relatively small number of huge stocks that had big up days. I think that's the story of the market today. It's not a broad advance. As you can see, there's a lot of things that are in the red or at least in the neutral color on this heat map. But the names that are up, it's a lot of big names, right? In the upper left, Apple, Broadcom, Palantir, all up 3+%. In consumer discretionary, Amazon, Tesla, McDonald's, those are 3 of the top 4 names in the sector, all up about 3+%. Even in consumer staples, Walmart and Costco, big box retailers having really good up days. So I think today was a story of mega cap names in certain sectors doing remarkably well. Otherwise, you can see a lot more of a mixed bag of performance today. And noticeably, a lot of red in kind of the bottom right quadrants. So healthcare, utilities, energy, real estate, materials, these are predominantly down sectors today. I mean, healthcare looked so encouraging not too long ago. It felt like this might be an emerging area of strength. And I would say there is still a relatively small number of names in the healthcare sector that are reversing higher. These are names that have been underperforming for quite some time, but Johnson & Johnson just made a new 52-week high yesterday. So it's down a little bit today, but these are stocks that are starting to, really make believers out of people. The problem is there's a lot more United Healthcare and Eli Lilly kind of names that have just been in these chronic downtrends. Amgen, which broke out along with other biotech names, but now just rotating lower over the last week. So I feel like there was a massive head fake where healthcare just sort of drew me in thinking, all right, maybe this is the beginning of something a little more significant. And then these Dexcom charts look absolutely brutal, just failing to get above resistance and pulling back. Good reminder to be patient, to wait for validation after a breakout. With charts like DXCM that trade to resistance, but not through resistance, stalling out right below those February peaks. Elsewhere, I mean, boy, the big box retailers being so positive, really encouraging. I didn't grab the chart of Walmart, but as you can see, we're sort of really close to making a new high here. This was the peak in February on an adjusted basis, around $105 a share. We then had that what's called a breakaway gap to the downside. That's an initial gap in a new direction. You can see a lot more deterioration after then. From there, we recovered off of the 200-day, and then we were sideways for so long. And there are a lot of charts that still look like this, right? Like Tesla's kind of like this, a sideways chart, not going up, not going down, but going that third direction of sideways. Very, very close, and to breaking out until today, when it with authority breaks above the resistance from the last 3 months. So this would pop up on my 3-month new highs scan if I ran it today, and above $100 a share, which is a big round number, which not surprisingly ends up becoming really an important pivot point for a lot of charts. So I think the breakout today is very encouraging on Walmart. Looking for follow through after a day like this is pretty important, right? Additional accumulation that happens after that. What else with the heat map? I don't think much right now. Maybe some strength in financials, right? Not huge up days, but like not down days, right? A lot of other things were struggling. Financials showing signs of a bit of a bounce here. It's hard to generalize on all financial stocks, and there are certain ones that certainly look better than others. But I would say generally some of these like BlackRock kind of Citigroup names that maybe pulled back after making recent new highs, as long as they hold short-term support, those are pretty decent charts. And overall could be kind of encouraging there. Yeah, someone mentioned Berkshire Hathaway. I mentioned unwinding my position there after a long period of time. Days like today, just boy, it makes you angry. That's not true. I stand by that decision, but I'm definitely watching it more closely now that I've exited a long time position in a stock. How many of you would say this, right? You have a position for a long time, you finally have the guts to sell it, and then you watch it like a hawk, just seeing if it ticks higher, so you can just yell at the market gods for cursing you so. All right. I'm going to see. I think I did a pretty good job of preparing. I actually did. I had so much going on with that other interview today that I didn't remember if I'd gotten through all the prep for the show, but I actually did. So yay. Before we get to the charts, by the way, I do see questions coming in on the different platforms. I appreciate you guys tuning in live, those that are doing so. And again, apologies for the late kickoff. I just had to be flexible today with the timing. I see a couple we can take here at the end, which will be fun. By the way, quick announcement. I was letting my premium members and market misbehavior know this earlier today, but just so you guys know, this week will be the last week of Chart This with Dave Keller for a couple weeks. I'm going to be taking most of the month of August off from this show. Dave needs a break. Dave's family needs a break. My daughter is going to be going to boarding school for her senior year in high school. We need to unplug a little bit. We're going to go to Ireland. We're going to be doing some stuff around the Pacific Northwest. Then I'm going to be moving her into our school in Northern Michigan. That's all happening in the next couple of weeks. So I'm going to be doing the things I need to do, and certainly keeping up content for my premium members, which have to be my highest priority. But the show is going to I'm going to hit pause on that. So we're going to go through this Friday. We'll do a mailbag episode on Friday, starting Monday, August 11th. And then for the next 3 weeks, no show. We'll be back after Labor Day on Tuesday, September 2nd. I know this is a pivotal time. And again, great opportunity to become a premium member, because that's where I'm going to be sharing some market comments. But I have to limit what I'm doing given everything that's going on. And that's where I have to prioritize things. So I'm going to be pausing this show. I'm going to be pausing the Market Misbehavior podcast. Going to be doing a lot of thinking about the different content that I'm putting out, a lot of the free content I'm sharing with all of you versus content that is dedicated to my premium members who are paid subscribers who I want to make sure have the most priority in my work. So I'll probably come up with an updated plan when I get back from all of that travel. If you have feedback, by the way, on what you would like to see from the show, what you like and suggestions on how I can improve it, go to my YouTube channel and drop a comment. Though I read those comments every day. I promise I do. And I would welcome your suggestions on what would make this daily discussion a little more helpful for all of you. But I appreciate your flexibility as I take some time off and refocus my efforts a bit. Hope you guys all, by the way, make time to take off here in August. Good time to do it. All right, let's look at the charts together here, and we'll wrap up the show after a couple questions. The S&P 500 chart still obviously in very good shape. Friday's drop below the 21-day EMA now being met with buying on Monday, and now through Wednesday we're seeing a close near the highs of the day today. So we're back around 63.50. That's back above the 21-day EMA. Our short-term kind of tactical support target of 6,200 holding for now. Note that the 50-day moving average is getting very, very close to that level as well. For me, that's kind of reinforcing the value of that 6,200 price point. For me, that's what I would call a line in the sand. This kind of environment, right? What I do is just sort of say, all right, overall, I'm seeing a primary uptrend still, but I'm seeing some short-term signs of weakness, as evidenced by my short-term model turning bearish on Friday. So what do? I think you lay a line in the sand. If we break this, then I'm going to start changing something, right? I'm going to be forced into taking action, getting more defensive, just changing allocations a bit, just revisiting a very bullish portfolio. 6,200 for me is that level. The fact that the 50 days right about there makes sense to me. So I think as long as we hold that, we're in good shape. Does this end up being like a head and shoulders top? That's a potential scenario here. But we'll see if that's going to hold or not. For now, still in decent shape. Breadth conditions in the short term have certainly gotten weaker. We've documented how the percent of stocks above key moving averages have come down. The end of June, we're at 80% of the S&P members above their 50-day. We're currently right around 50%. So that means a third of the S&P have broken their 50-day moving average basically in the month of July. That tells you there's some weakness, right? There's some stocks pulling back and not holding that kind of key short-term level of support. Now, these lines are both still constructive, right? They're both above 50%. But if they would break below that 50% level, that's where I would, be concerned about further downside potential. For now, we're in okay shape. Shout out to my longtime friend, and I would consider a very valuable mentor, Walter Deemer. Walter, and do want to shout out to Walter. His wife of many, many years just passed away recently, and my heart goes out to Walt and his family. Bobby was a wonderful woman and a Buckeye as well. So I had a quick exchange with Walt, sharing my thoughts along those lines. Walter still, after an incredible career in the financial industry and a well-deserved retirement, is still sharing charts and throwing things out there. And I'm really thankful that he shared this chart here recently. He shared a different chart, but this is my, sort of my way of addressing what Walter talked about. He showed a chart looking at the NASDAQ 100 versus the NASDAQ Composite. A lot of times people kind of blur those two indexes as the same. In the top, I'm showing the QQQ. This is the NASDAQ 100. So this is the 100 basically largest names in the NASDAQ for all intents and purposes. The NASDAQ Composite is the entire NASDAQ exchange, sort of like the New York Stock Exchange Composite Index. So it's kind of like the difference between the S&P 100 index, the OEX, and the entire New York Stock Exchange. It's not exact, but that's kind of how we're thinking of this, right? Very different group of stocks, a much bigger universe with arguably a lot more kind of smaller, crappier companies that are embedded in there. Now, if the New York Stock Exchange index has a lot of crappy companies when you get to the bottom of the list, the NASDAQ Composite is even worse because it's a bunch of stocks that couldn't get listed on the S&P, on the NYSE are listed on the NASDAQ. That was the traditional kind of thing. That's why breadth indicators on the NASDAQ Composite are not super helpful a lot of times because there's just a lot of crappy stocks on there. That's an industry term, just a lot of junky names that are not particularly good companies that manage to get listed. And so as a result, the breadth usually skews kind of negative if you look at the larger universe. That's why I usually look at the NASDAQ 100 for like the bullish percent index, because it's just a better, reflection of that group of growth stocks. Having said that, he had posed a question, are you surprised at all that the NASDAQ 100 has underperformed the NASDAQ Composite? So while the NASDAQ and the NASDAQ Composite have rallied off the April low to make new all-time highs here going into August, the relative performance of the NASDAQ 100, the 100 biggest companies versus the NASDAQ Composite is actually trending down since the April peak. This doesn't surprise me a lot because other breadth indicators we've been talking about, like the bullish percent index on the NASDAQ 100, which I actually have as the next chart we're going to look at here. We'll look at another chart sort of looking at this in a little more detail. That has been showing a lot of weakness with the biggest names. So for every Palantir or NVIDIA that are like these long and strong tech AI kind of charts going up, there are a bunch of like AMD kind of names that had been doing very well and are now starting to rotate lower. And so what that means is the big mega cap growth stocks aren't necessarily as a group the best place to be. And I think the relative performance of the NASDAQ Composite is doing this. And so this is basically saying the largest names are underperforming the rest of the index, which means the rest of the index is doing better than the NASDAQ 100. It's the other stuff in the NASDAQ that's really starting to do remarkably well. We're seeing that in the bullish percent indexes as well. This is the NASDAQ 100's bullish percent index. So what percent of the NASDAQ 100 stocks are in a bullish point and figure profile. It's around 47% today. Here's the bullish percent index on the NASDAQ Composite, which is up around 53%. Now, the range is pretty skewed here because you can see the 50% line I have in blue, the 70% line is in red. This indicator never gets up to 70%. And that goes back to the fact that in the NASDAQ Composite, there's a bunch of crappy names that are just never going to be great companies or great charts. So the index never really gets very high. So the NASDAQ 100 breadth can get very, very strong. The NASDAQ Composite breadth never really gets that strong. But just look at the direction in these two lines from mid-May to now early August, right? The trend in the NASDAQ Composite breadth has been going higher. The trend in the NASDAQ 100 breadth has been going lower. This is currently below 50%. This one is not. So again, reinforces, I think, the point that Walt was making, which is if you're limiting your attention to the 100 members of the NASDAQ 100, those growth names we all know, you're missing some of the better performers here off of the April low, and certainly since mid-May. And my analysis of breadth, separate from Walt's comments, I think completely validates that. So thanks, Walter, for sharing that chart and making me think about that relationship between breadth indicators. All right, bond prices rotating higher. We've talked about a bit of a rotation here. I just want to point out that the TLT did pull back to its 200-day moving average earlier today, but closed back above it. And so overall holding support after the breakout that we observed at the end of last week. Stocks and bonds generally kind of popping higher here this week. We'll see if that trend continues. But I think strength in bond prices, as long as the TLT holds above the 200-day moving average, pretty important. By the way, on yesterday's show, I had a question I didn't get to asking about why the TLT on your charting platform, whatever it was, is not above the 200-day moving average, and mine is. My guess would be this. Your chart probably looks like this. What I did there was I took the dividend adjustments out. On stock charts, they default to adjusted price data, which means most stocks and ETFs pay a dividend. And when a stock or ETF pays a dividend, you basically reduce the price of the stock and pay that out in the form of a cash dividend. That's how dividends are accounted for on the price chart. So on an unadjusted chart, you will see these little gaps lower randomly once a quarter or whatever, which is the company or the ETF, whatever, paying out a dividend. And so the price comes down and that's paid out in the form of a dividend. But John Murphy, who was, whose work really inspired most of the approach on stockcharts.com, was a big fan of adjusted data because he said those little dividend adjustments make your indicators all messy, right? It makes the RSI go down, even though there weren't people selling because of some behavioral emotional thing. That's just a dividend. So we should strip the dividends out. We should adjust the historical prices to reflect pure investor behavior and not thinking about those dividends. And so as a result, it defaults to an adjusted data set. Most charting platforms will give you an option as to whether you want to look at adjusted or unadjusted data. They all do it differently. So I wouldn't be surprised if this is the first you've heard of it, or if you're not really understanding a lot of what I'm talking about. But that is the reason. So your chart probably looks like this, which is the unadjusted data set. Some charting platforms default to that way of analyzing prices. I tend to use the John Murphy methodology, which is you use adjusted data, and as a result, the TLT is back above its 200-day moving average. There's a little market data charting lesson for you for the day, for what it's worth. All right, let's look at some individual stocks here. Looking at AMD, we did pull back after earnings yesterday, gapped lower, ended up closing around 6.4% to the downside, did trade below the 21-day EMA, but closed back above it. I see that as a pretty encouraging sign. Market uptrends are often marked by dramatic pullbacks to an ascending 21-day EMA. As long as it holds that on a closing basis, I think we're still in good shape. For now, AMD's doing that. The real concern is where we don't hold the 21-day EMA. Even worse is if we would break the 50-day moving average. So the way I would generally think of a chart like this, breaking the 21-day EMA, big question mark, breaking below this level of support, which is around 142. That would be the first Fibonacci support level and the 50-day moving average. For me, that would be let's get out of the way, because this could be the beginning of a much more significant decline. For now, short-term pullback within an uptrend until we break that level. I don't know if you saw the alert at the top of my login. Breaks my heart. Dave, the ticker that I'm named after, or that's named after me, whatever it is, I get this big alert at the top of my screen. Dave crosses below 185. There's a breakdown in Dave Inc. It's a nightmare, right? This is my namesake chart. It's not the end of the world yet. I don't have a position on this. I'm saying that with a great deal of sarcasm, but this is a company that randomly people will ask about because it has my name on it. And what's interesting is it's actually looking like a big head and shoulders topping pattern. A head and shoulders top is confirmed if and when you break below the neckline, which is formed between those interim lows, and it's kind of right there hanging at 180 today. We did close above there, almost back above $200 a share. It's down about 18%. I don't have a position in Dave Inc. If I do, though, I would be concerned after that pullback that we saw today for sure. And I think any further deterioration, a follow-through day tomorrow that we complete that head and shoulders pattern would basically suggest a move back down to the 200-day moving average. If you look at the height of the pattern and then project that from the breakdown level. So at a crucial level of support. Also got a question about cannabis stocks, which I haven't had a lot of questions about. And I'm not surprised because these charts have been so brutally bad for so long. Now, full disclosure, I do have a position in this ETF, in YOLO, that I've had for a while. And this is a bet on, improvement in the cannabis industry. The deregulation or the, legalization of cannabis products state by state has been a kind of a, generally successful thing in a lot of places. But the reality of companies actually trying to make a profit selling legal cannabis when you're still fighting against a black market that can undersell you and has no regulations, turns out it's pretty tough to make a profit. As a result, ETFs like YOLO have been aggressively moving lower. But if you look from the April low to where we're at today, it's been quite a bit of an improvement here. It's not a double off the April lows, but YOLO is actually improving, and it's back above the 200-day moving average for the first time in a year. You have to go back to July of 2024 for the last time this was above the 200-day. So maybe an encouraging breakout there. A long time coming for cannabis stocks that have been struggling for so long. All right, let's take a question or two. 3P Investor, thanks as always for watching. You mentioned, I just saw this at the end. Boston Scientific made your top 10 stocks and Grayson's top 10 for August. Such a high correlation coefficient makes me think I should take a small position. I love that. Not a recommendation, as you know, but I appreciate you pointing that out. I actually just put out my top 10 charts for August. I did that on Stock Charts TV. So if you go to the Stock Charts YouTube channel, you will find that on there. I just put that out on Monday. Grayson and I couldn't make the calendar work out we often do that together here in the Stock Chart studio. We're planning to start that back up next month, by the way, in September, but we couldn't do it. So we actually both independently put out our top 10 list. I haven't looked at Grayson's list yet, but if you're correct, which I assume you are, that's actually interesting because we always show up. We rarely actually share the charts ahead of time. We kind of show up and I'm like, all right, what do you have? And we start looking at each other's and then we think about what order we want to bring them out in. And sometimes we don't even tell each other. We just kind of light it up right as we go. And if we both came up with this name together, I think that's pretty compelling. For me, it's, it's a setup is different from the actionable entry point. And the way I would think of this is a key resistance level around 107 to 108. I think this is an exceptionally encouraging chart above 108, which would finally break out of that base. Until that happens, I'm sit on your hands mode. I'm wait and see mode because it's just not breaking out enough. This is a big base breakout if and only if we can propel above that well-established resistance level. But thanks for checking that out. Grayson's awesome, and you should check out his top 10 list of charts as well. What else can we answer? A couple of questions about the Mag 7. And Bull Bear Jeff, thanks as always for watching. You're a longtime watcher, and I very much appreciate that. The Mag 7 has been underperforming the NASDAQ Composite for 3 months now. And it's very, very true, right? You can see that in measures of breadth. You can see that in relative performance of the NASDAQ Composite and the NASDAQ 100, particularly like equal weighted measures. You can see that that's been the case. And someone else mentioned, I think the Magnificent Seven, things like, monikers like that are really helpful for a period of time. And that's been the case. I remember the BRICS. Remember Brazil, Russia, India, and China? At one point, it made a ton of sense to think of the BRICS, right, as this group of 4 main, kind of developing economies. and because they were like the force, right? They were a thing. But then not soon after, the bricks became very different, right? They've had very different return profiles since that moment, right? And so things like that make a ton of sense until they don't. There's a limited window of time where the FANG stocks are the most important things, and then it kind of evolves because market conditions change. And so I think when we come up with new monikers, that tells you something's starting to change, right? That tells you there's a change of character. So maybe the Magnificent Seven, that's a period of time that maybe at some point is behind us. You're certainly seeing some differentiation, some divergence between these charts. Like Tesla are a far cry from charts like Nvidia. Even within technology, just look at Microsoft versus Apple. They're very, very different. So yeah, I'll be maybe that's something else I'll think about in August, a new moniker that I will share with you for the new thing, and then we'll see if it takes off. It'll start here on the show. That's the goal. NASCAR all out. Boy, I'm not a NASCAR fan, but I'm a huge fan of people boldly making it your handle. So I appreciate you watching, and I appreciate your question. Are you in the camp that AI is taking over the world, or in the camp that AI is a bubble? And I appreciate that question. I'm going to answer because I think it's really thoughtful. It's something you should think about. Where I would say that investors often get into trouble is because you think of AI, the technology, and I think it's the same with cryptocurrencies or so many other kind of bubble-like things that we've seen, investment fads that kind of come out, and then like everyone buys into this idea. We've seen this how many times in market history. And then again, for me, I immediately think back to my early formative days as an investor in the early 2000s. I started in the industry in June of 2000. The tech bubble was in the process of bursting, although people did not believe that for quite some time. At the time, it was, pretty much the assumption was that technology and internet names were just going to, .coms were just going to continue going higher forever. There were magazine covers called The New America and The New Economy, talking about how you can value companies on eyeballs, and valuing things based on actual earnings are outdated concepts, and we should think more about the promise of this new internet technology. I mean, it worked for a while until it didn't, right? Remember that Netscape was a transformative technology and an incredible company, which is no longer existent because web browsers worked, and it changed the way we, think about information and gather information, until other companies and other technologies kind of came in and took what they started and then built it into much other things. So I think the problem for some AI kind of companies or AI stories now is they're kind of the Netscapes. They're the companies that are doing really well right now. It's very hard to tell which companies are going to be doing well 5-10 years down the road, and are the ones that are really going to be able to take AI and make it into the next, and sort of evolve the technology well beyond where we're at today. That's very much unclear. So will AI be a transformative technology? I think it already is. I mean, just what I do day to day is impacted in so many ways by AI. Even the way I edit videos, the video editing tool I use has a whole AI plugin that does a lot of it automatically that I used to have to painstakingly do or ask a producer to kind of edit. It now does it without me even thinking about it. I mean, that's a little bit scary, but also quite helpful as a productivity enhancer. So AI as a technology, absolutely transformative. Is it clear right now which companies and stocks will come out the big winners over a longer period of time? It's not as clear as some will tell you. Some will say Palantir's the company and it's going to go up 10x because of blah blah blah. I don't think that's as obvious right now. People will say that, they really don't know it. And I would, again, don't forget about Netscape. There are a lot of people talking about Netscape taking over the world. It did until it didn't. Keep that in mind as we talk about artificial intelligence and other things. With that in mind, that'll do it for today's episode. Again, we're going to be back tomorrow on Thursday, August 2nd. 7th. We'll do an all mailbag episode on Friday. And then we will call it a break, and we will take a break for the rest of the month of August. But for now, I say thank you guys so much for watching. Thank you for supporting me in market misbehavior and giving me a place to share charts and insights. I wish you guys a great evening. And remember, it's always a good time to own good charts. Take care, folks.